Good morning and welcome to your Financial Empower Hour. This is Jason Cryderman with Great Lakes Investment Advisors. Happy Sunday, Mr. Tony Shore. Can you believe as we record this show, it is the third week of September, actually the first day of fall. So as our listeners and viewers are watching this, you're almost 1 week into fall and less than a week away from October. I can't believe it, Tony. I know that the weather has changed over here drastically over the last couple of weeks. The leaves are all changing. We're setting into fall weather. And I got to be honest with you, Tony, fall really is one of my most favorite times of the year. I mean, I really, truly love all the four seasons of Michigan. I really do. And it's the transitioning into and out of each of those phases that I think is really so exciting and appealing to me. I was telling my family over the weekend that I really love, and I know it's coming into fall, when in the evenings you can put on jeans and a hoodie and you're comfortable.
Yeah.
Yeah. Think about
I like that too.
Yeah. I mean, jeans and a hoodie weather to me, jeans, hoodies, socks and tennis shoes. Now, the opposite of that, of course, is after we come out of winter and spring, it feels so darn good to be able to put on flip-flops and t-shirts and shorts. Yes. Yeah. And it's then transition into that. So
I love being able to bring out the short pants. You know that.
Absolutely. Well, with the legs of you, Tony, with legs like yours, everybody loves when you wear the short pants.
You know, when you go to buy copier paper, they have 90% bright, 85% bright paper. I'm at a 95 to 100 bright paper. Copy paper. You put that next to my leg, and it matches.
It matches pretty good.
I have 3 stages: white, burn, and peel. There is no tan. But you know what? Back to fall. We're recording this on the first day of fall, and it is my favorite time of year. The air is crisp, fun to get outside. The leaves are changing. I mean, what's not to love, especially here in the Midwest and in Michigan and Wisconsin, Minnesota, Illinois. It's a beautiful time of year. Right.
Yeah, I'll tell you what's not to love. You just asked a quick question. What's not to love? And I'll parlay it off of you said leaves are changing colors. Well, I love the changing colors of leaves, Tony, but what I don't love, what's not to love, is all the darn leaves in the yard, right? And then we have to rake and leaf blow and rake again. And what really gets me is when you spend like a half or 3/4 a day on a Saturday or Sunday and you rake or leaf blow the yard and it looks absolutely beautiful. And then you wake up the next morning and it looks absolutely horrible. The leaves are all over the yard again. So that's the only thing I think I really dislike about fall. I love the changing colors. I know you and I will really get into it maybe a little bit on this show, or especially one of my future shows where I can get my son Carson on the show again with us, because we get into this time of year for football.
We got to talk about football. I think this is a good day to talk about football. I don't know if you saw the Vikings game this past weekend or saw the results.
I did not see the game.
48 points we racked up.
Did you really?
48-10, we beat the Bengals, and they hadn't lost a game, by the way.
Okay. Well, the Bengals are definitely a different Bengals now than Bengals of years ago. That's
sure. Well, they hadn't lost a game yet this year, but they lost to us 48-10.
Wow. Well, good job to the Vikings. Now, as we record, it's noon on a Monday as we're recording, and so tonight, the Lions play the Baltimore Ravens on Monday Night Football. So as we're recording, we have no idea what the outcome is going to be. But as you guys are listening or watching this show next Sunday,
Lions!
Wait a minute, we already know how that turned out. So so go Lions. Hopefully, we can have a great game against Baltimore, and then next week when we record the show, hopefully we'll be talking about, hey, both teams won last week. The Vikings won and the Lions won. So. Yeah, it's exciting time of year. Again, football weather, I love it. Hunting season, I love it. Carson and I had a chance 2 weeks ago to get out for the youth hunt. We had an awesome time, father and son, sitting in the blind together. Saw a lot of deer. Just didn't see a big shooter buck get in close enough for us to get a shot at it. But I always I tell everybody when Carson thinks we're hunting, right? And there's an old country song that says she thinks we're just fishing. It's about the dad taking his daughter fishing, and she thinks it's all about fishing, right? And it's not. And it's the same thing with Carson and I. When I take him hunting or fishing, I think about that song all the time. And I look over at him, and he's looking through the binoculars at deer, and he's talking about it. And I think he thinks we're just hunting out here. And Tony, Yeah, we're out there to hunt, but it just swells my heart to think about the individual time I get to spend with him, and
Yeah,
then teaching
that's
him
what it's
about the great outdoors and about hunting and fishing and how to be a sportsman and how to obey the laws and just the right things to do to have fun. And ultimately, at the end of the day, he just wants to either shoot a deer or catch fish. So
Yeah, that's true. Yeah, he has a goal in mind when you go out, but it's for you especially and him looking back on it, he will appreciate all that time, whether you get one or not. It's the time spent together and being in the outdoors. It's
yep,
so great.
absolutely.
So
Yep.
great. But this is a great time of year. So you did not go hunting this past weekend. What did you do this past weekend?
No, so this past weekend was the youth hunt was the weekend before that. So this past weekend was awesome. It was a really cool weekend for my family, Tony. So this was homecoming week for Meridian. So we
Oh,
had the homecoming parade up in Sanford on Friday at 5, and then we had the
nice.
homecoming football game, and then we had the homecoming dance on Saturday. Josie went to the dance. She also cheers as a varsity cheerleader, and she's also in the band. So she was in the parade, she was doing the game, and she went to the dance on Saturday.
You and your
And that
wife
was
didn't
awesome.
chaperone?
So we didn't. No, we
You didn't
didn't.
go to the dance to
We were
embarrass her?
we were told by our kids when Lexi, so this was 5 years, 4 or 5 years when Lexi was a freshman and got to go. We were told then we are not allowed to chaperone any of those dances because they're too afraid that they don't care that we're there, but they care that Dad is going to embarrass them for the
Well,
rest of
sure.
their lives.
Yep.
Especially nowadays, everything's recorded on phones.
It's
So
what dads are for.
back in our day, okay, your dad embarrassed you for about 5 minutes, but then everybody forgot about it and nobody had proof. Well, nowadays,
Right.
these kids have their phones everywhere. They know if dad does something dumb and embarrasses us, that's going to be recorded forever. And
Yeah.
dad's going to go viral on Snapchat or whatever these kids use nowadays. So, no, we did not chaperone, but it was really cool because Lexi got to come home from Michigan State this weekend. They had an away game, as most of our listeners and viewers know. Extremely late game was Saturday night, did not start till 11 o'clock. And believe it or not, Tony, at 51 years old, I was able to stay awake until kickoff. I may have dozed in and out a little bit through the game or at halftime, but I was awake at the end of the game, and I just impressed myself at 51 years old. I didn't know if I'd be able to make it till 2:33 in the morning anymore. But it was, it wasn't the
Wait, a
greatest
high
game.
school game that kicked off at
No, this was Michigan State. I'm sorry. This
Oh,
was
Michigan State didn't kick off until 11?
They didn't. They played out at USC, so they were in California. Kicked
Oh,
off at
okay, I
11
get it.
o'clock.
A couple
And
hours earlier out there.
yeah, 3 hour, and that's why I had
3
mentioned
hours, yeah.
Lexi got to come home because they didn't have a home Michigan State game, so we didn't go down there and go to tailgate or go to the game. Michigan State was on the road, so that was the game I was talking about. Started at 11 o'clock.
Oh, okay. So
Unfortunately, didn't.
you stayed up for that, huh?
Believe it or not, and I
Wow.
kept telling my wife and kids, I don't know at 51 years old if I can stay up till after midnight to watch a football game anymore. But I did. I stuck it out and was able to watch it. The outcome wasn't the way I wanted it to be. It was a little better than what the odds and Vegas was saying was going to be, but that's a tough road, go all the way out to California, play an 11 o'clock PM game. It's tough. We had a lot of injuries. We had a very unfortunate, I don't know if you saw the game or the highlights, but they actually had a linebacker carted off in an ambulance.
Oh, no.
He was able to get out of the hospital the next day, make the flight home with the team. So he is injured, but he at least wasn't paralyzed, which some people thought, boy, by the looks of what happened, he might have been. So anyhow, it was an awesome weekend though, because again, Lexi got to come home and it was homecoming for Meridian.
Yes.
So she was able to participate in the parade. She was able to participate with the band on the field. She was able to participate with the cheerleaders on the sideline, and just watching her in the stands, talking to all her old classmates that came back. That's and neat. Kids she used to go to school with, and the parents and the teachers. And it was really cool. It was an awesome weekend of football. It was an awesome weekend for family. I drove her back down to school yesterday and said, I think we're going down there next weekend. They have a bye week. Then we won't be going down there again until October 11th, and that'll be Michigan State's homecoming.
Yeah.
So
we went and saw my daughter at her parents' weekend, even though she's not a freshman anymore. We still go to parents' weekend.
Well, it's still parents' weekend, right? It's not just for the freshmen.
No, and that's what we told her, and she was kind of embarrassed. Why are you guys coming down? And then I don't want to go to the events at the school. What if people see, it'll be all freshmen? And I go, no, it won't. We went to the homecoming game, and I went and saw a comedian and he is from Anchorman. His
Okay.
name, he was the guy who played. His name is David Kochner, or Ketchner. I never
Okay.
know how to pronounce, but he was in both Anchormans. He had a movie called The Comebacks. He was also in The Office, and
Okay.
he
Yeah.
did stand up at her school for Parents Weekend. They brought him in as a stand up comic, and I want to tell you, if you get a chance to see David Ketchner's stand-up comedy. It's Koechner. But you remember Anchorman, the movie with Will
Oh yeah.
Ferrell, the
Yep. Oh yeah.
sports guy who goes whammy,
Yeah.
and
Yeah.
he kind of has his lip goes out
Little side
whammy.
lip face. Yep.
Yeah,
Yep.
the side lip guy. He is so nice. We got to meet him afterwards
Oh, that's
and get a
great.
picture with him. And he's been in so many movies and TV shows, but he's a stand-up comic and an improv guy, and he was funny. I mean, it's one of the, I laughed so hard. And my daughter said, "Well, I don't even like stand up." She was laughing so
Oh, that's
hard.
so cool. Sounds like you guys ended up having a great time.
Yeah, yeah, but he did some lines from Anchorman, and but at first his first 20 minutes, it was a school in Minnesota, and he pretty much just made fun of the town, Minnesota, like talked to people in the audience, made fun of
Yeah.
people in the audience, and so he was good at the improv, so that was fun. I feel privileged that I got to meet him because he's really good, and he was in The Office for a few episodes where he played the fill-in boss
Okay.
when the main
Yeah.
boss
Very
on that
cool.
TV series, The Office, was out. Very funny guy. I highly recommend going to see him if you get a chance. One of the funny, and I've seen a lot of stand-ups like Jim Gaffigan and Nate
Mhm.
Bargatze. I think this may be the funniest I've ever seen, honestly.
Really? So he was
Yeah.
that good. He made a heck of an impression on you.
Oh man, he was good. So let's take a quick break here and jump into the finance. Today, the Fed lowered the interest rates. We talked last week about what if
Yep.
that happens. It probably will. But now that it has happened, what does that mean? And I have a lot of questions to ask. But before we do that, Jason, I'm going to give away some copies of your book for the next 10 people who contact your office via phone or web and fill out the contact form. Someone will call you back. Say you want a copy of Jason Cryderman's book, Empower Your Retirement. And all you have to do is call 989-835-7203. That's 989-835-7203. There's no charge, there's no obligation, there's no shipping. We'll send you a copy of the book, or better yet, you can set up a no charge, no obligation consultation with Jason and his team there. I think that's a fantastic offer. Just call Great Lakes Investment Advisors at 989-835-7203 or go to the website, greatlakesinvestmentadvisors.com. And you're listening to Your Financial Empower Hour. I'm your co-host, Tony Shore. I'm here with our host, Jason Cryderman. Jason, we're going to talk about the Fed and how they lowered interest rates finally. Been
Yep.
talking
Mhm.
about it all year. Hopefully they were going to do it, maybe even a couple of more times. But lower interest rates set by the Federal Reserve can affect people's personal finances in a number of ways, right? So what's the first? Like for borrowers, like if I want to borrow money, it's a good thing, right? Let's focus on the positive here first a little bit.
Yeah, so we'll kind of talk about two scenarios. We'll talk about the borrow when you borrow money, how interest rates affect your borrowing capabilities, and then also when you invest money. So interest rates are really what we call a double-edged sword. And yeah,
Yeah.
we had Tyler Ellegard, portfolio manager from Gradient Investments, on the show last week, and he said that their view, Gradient Investments, was really assuming the Fed had been led up to lead us to believe they were going to raise interest rates 1/4% this past week, which they did. And then he also said that he's up to believe that they're going to do this 1 to 2 more times as they meet in their October, November, towards the end of the year meetings. And the Fed's vocals lead us to believe that as well, that they're going to have a couple more interest rate drops coming yet this year. So let's talk about what that means for borrowers. You ask, Tony, how does that impact borrowers? Well, when you borrow money, we want cheap interest rates, right? We want to that means the amount of money we pay to borrow money. So if I can buy a new car at 5% or a new car at 7%, that means I'll pay either 5% interest on my loan or 7% interest on my loan. I rather borrow at 5%. So as borrowers, we want to pay less. We want lower interest rates because it's easier to borrow money. It's a smaller payment. So we can finance more things. Not only is it for us as consumers, but for corporations as well. And again, Tyler Ellegard from Gradient touched on this last week. Us as consumers drive a lot of the market and the economy, but these corporations do as well. So as corporations can refinance things in their books, in their balance sheet, whether it be bonds, their own corporate bonds, whether it be them borrowing money, mergers and acquisitions, whatever it might be, they as well can get money cheaper when Feds lower interest rates. So if everybody can borrow money cheaper when interest rates go down, that is potentially a stimulus for the economy to help boost people to go out and borrow money to then buy another business or mergers and acquisitions, or spend money back into the economy by buying a house or a car. So lowering interest rates, I think, is a very good thing for the consumer when we want to borrow money. Even for corporations and businesses, it's a very good thing when we want to borrow money to have lower interest rates.
Mm-hmm.
But we also have to keep a mind on, Tony, when these companies get a lower interest rate, that means they're also not making as much profits. And we want to see these companies make profits when we want their stock to go up. If we're investing in them, we want them to have growth. Well,
so it's a fine line.
It's a fine line, yeah, because the financial institutions, when they now lend money out for less income, well, maybe that could have a negative impact on their portfolio, excuse me, and on their overall stock price long term. So there's a fine line there. But I think overall, I always compare it, Tony, to when interest rates a few years back, interest rates were, let's look back maybe to the early 2000s and early to mid, and interest rates, it was nothing to have a 6 or an 8% interest rate on your mortgage, on your house. And then all of a sudden interest rates went down to zero, and people were refinancing their house every single day. There was people refinancing to get 4%. 3.5%, 3%. I had heard of some people getting less than 3% on their mortgages when they refinanced. What an amazing, amazing, cool opportunity to save money by cutting your interest rate on your mortgage down from maybe 8% to 6% or 5% or 4% or lower. What a very cool, powerful refinance opportunity. So as we see moving forward now, with interest rates just being cut last week by the Fed, and we're anticipating 1 or 2 more cuts yet this year, and we'll see what happens into the first part of 2026. But as we see interest rates gradually come down, and I mentioned gradually because all these companies that utilize interest rates, whether it be for financing or when you borrow money as an interest rate, or when you invest money, and we'll touch on that in just a minute. But when you borrow money, these companies now, their interest rates they're charging are going to come down as well.
Yeah.
Some companies are going to come down faster, some slower than others, depending on the market, depending on the company. But that's a great opportunity for people looking to refinance their current debt, whether it be current credit card debt, mortgage debt, car, whatever it might be, or to take advantage of new opportunities to purchase things, acquire new debt at a lower rate. So those are, I think, are very positive. I think things that our consumers really are going to be able to take advantage of as we see the Feds with this current lowering, as well as they may lower them a couple more times yet this year. And we'll see what they do into 2026.
Yeah. I mean, I've heard some from the Fed board, from the Federal Reserve, kind of a little iffy on if and when and how much they're going to continue to lower them. I know the pressure from a lot of people and the administration. There's still pressure there to lower them even more. They just lowered them 1/4 point, as you've mentioned. But it will positively affect how much you have to pay for loans and things.
Absolutely.
If you're borrowing money for cars or especially mortgages, right? That's what people mainly look at.
Yep. Mhm.
And there are positives and negatives. But first, let's take a quick break, and then we'll look at some of the specifics on this. There's a lot here. Interest rates affect all of us, whether you think they do or not, whether you care or not. It's going to affect you, and especially as you head toward retirement or in retirement, your retirement savings and planning. Interest rates play a role. So that's good. And you briefly touch on that in your book, Empower Your Retirement,
Mhm.
which is a great book. And Jason wrote this book. He and his dad wrote a book with a lot of great information in there, from investments to maximizing your Social Security, long-term care costs, market volatility. You address a lot of things that people need help and advice on. It's a great resource. So for our listeners, the next 10 people to call in and request a copy, or contact us via the web and request a copy, when we get back to you, we'll get back to you. Or to set up a no-charge consultation, just call 989-835-7203. Mention that you heard about this on the radio show or podcast. That's 989-835-7203. The web address is GreatLakesInvestmentAdvisors.com. And this is your Financial Empower Hour. I am your co-host, Tony Shore, and we are here with Jason Cryderman, the man with the plan. And this is a fascinating topic because it always hits the financial news. The regular news too covers it when the Fed says, hey, we're going to lower interest rates or raise interest rates, God forbid, in some cases. So for borrowers, it's a positive impact, though, right? If you're borrowing money, you don't have to pay as much in interest rates, like a mortgage, right? Refinancing opportunities, right?
Yeah, that's very true. So for the most part, when we borrow money, we want lower interest rates. So it's very positive when interest rates are reduced for people or businesses that are borrowing money. That means we can borrow money cheaper. So maybe we can borrow more money more often, less payments. All those things are good for the consumer and businesses when we look to borrow money as lower interest rates. But I've said many times on the show, I think I have a tagline in my book that says this exact same thing. And I know I talk to clients every day about it, but interest rates are a double-edged sword. Interest rates are kind of like those things we want to have our cake and eat it too. And you've heard the saying, Tony, we can't have our cake and eat it too, right? Well, what the heck does that mean? Well, when we talk about interest rates, I'll make it really simple. We want low interest rates when we borrow money. Totally makes sense. It's cheaper for us to borrow money with low interest rates. However, we flip the interest rate coin over and now we're investing our money, whether that be into any kind of fixed investment vehicle like a savings, a money market, CD, a fixed annuity, multi-year guaranteed annuity, anytime, or even bonds with higher yields. So when we invest in those type of investments, we want higher interest rates. We want to be paid more.
For savers. Right? Yeah. Investments, and we want higher interest rates because when those interest rates went up, a lot of people invested in, like, CD rates got better.
Absolutely.
They got a little better. And then things like MIGAs, the multi-year guaranteed annuity, a MIGA, which is like a CD, except it's through an insurance company. And those rates, typically the rates are a little better than CDs. And those rates for a while got amazingly good, even short term.
Yeah, they really did.
So you didn't even have to lock in for that long to get pretty high rates.
You really didn't. Nope.
Yeah. Or if you wanted to lock in for a long time, you could get decent rates too.
Well,
which is
we'll talk
now
about
becoming a problem, right?
Yeah, we'll talk about that because it's a potential problem and it's a great opportunity. So we'll talk about that in just a couple of minutes, because I do think when we refinanced our debt, so when we had a higher interest rate and all of a sudden interest rates were lower, everybody refinanced their house, or you refinance your credit card debt. You refinance debt when you know you can get a lower interest rate. It's a no-brainer. Why don't I refinance to pay less? That is a no-brainer, right?
Yeah.
Well, I think we have a heck of an opportunity that since 2022, when interest rates went up and inflation went up and the Feds raised interest rates, and all of a sudden people are realizing, wow, I can get 3, 4, 5% in a money market at the bank, or I can get a 4 or 5% CD at the bank or credit union, or like you mentioned, fixed annuities, or what they call MIGA. That stands for multi-year guaranteed annuity. They were paying over 5%, over 6% guaranteed rate of return. What an opportunity. I mean, we went from interest rates paying zero. I mean, it wasn't long ago. My viewers and listeners are going to remember this. You get a 5-year CD and you had to pay the bank money, right? I mean,
it was about
anything.
maybe 1%.
If you got 1% in a CD, you were lucky, and you had to give them
Right.
your money and your firstborn for the rest of your life. I mean, it just
Yeah.
didn't make any sense.
No.
So now, even now, with interest rates still being elevated, and this is maybe an opportunity for our listeners and viewers to really focus on and take advantage of. Number one is your debt side. When you're borrowing money, yes, refinance to get lower rates. But on the investment side, on the saver side, the investment side, now's a great opportunity, but this opportunity window very well might be shrinking. What I mean by that is, as the Feds are lowering interest rates, we will see banks, credit unions, insurance companies, those types of fixed income investment companies, we're going to see rates decrease as well. CD rates are going to come down. Savings checking, high yields, annuity rates, bond yields, all these rates are going to be negatively impacted when interest rates come down. So there's that double-edged sword. Gee, when the lower interest rates, I can borrow money cheaper. Yes, that's a positive thing. But with lower interest rates, I'm also going to potentially make less return on my fixed investment vehicles, my fixed rate vehicles. And that is true as well. But I want our listeners and viewers to think about this as an opportunity that we might have for the next 3 to 6 months, maybe a little longer. You might have a great opportunity to look at refinancing your investments. Remember, when you refinance your debt, refinance to pay less, that's a no-brainer. Well, refinancing your investments to make more, that's a no-brainer as well. And Tony, we've been helping literally hundreds of our clients year after year refinance when they have CDs come due, or money markets, or annuities come due, or other types of vehicles that they just want to earn a safer rate of return on without high risk or high fees. We're looking at refinancing a lot of investments over this last 3 or 4 years since interest rates went up, because a lot of people have CDs coming due, or annuities coming due, or other types of vehicles. And instead of renewing at 5%, we're going to see those start renewing at maybe 4.5%, 4%, 3.5%, 3%, meaning rates are going to go down. Usually, historically, banks and credit unions will reduce their rates quicker than insurance companies will. And why do I mention that? Because you already said, Tony, the insurance company offers a vehicle called either a fixed annuity or a MIGA, multi-year guaranteed annuity, or even a fixed index annuity. It's important to point out to our viewers and listeners, though, Tony, we're not talking about variable annuities. Variable annuities we're not talking about in this case. Variable annuities have internal fees, they have internal risk.
They have high fees, high risk, whereas a lot of the fixed index or MIGAs, you have principal protection. So there's the downside risk is eliminated.
You really don't want to compare variable annuities with fixed vehicles like a MIGA, a CD, a fixed annuity, an index annuity.
Because fixed index annuits, you can get those with little to no fees at all. But a variable annuity usually comes stocked with fees.
Right. Yep. So I just want to make sure, just make that clear. That's not what we're talking about today for our listeners. We can compare other investment products to those variable annuities. But today we're talking about vehicles that are risk-free and most of them even fee-free as well. So they're more your safe money vehicles. But what you want to consider doing is refinancing those vehicles. Refinance maybe an old annuity you have that's paying 3%, which was a great rate 5 years ago. But now you can get 4.5%, 5.5% guaranteed. And Tony, as you mentioned, it's pretty cool with a MIGA that you can get this guaranteed higher rate for 3 years, 4 years, 5 years, which to me, let's think about that opportunity. If we know interest rates are probably going to keep coming down in the future, are you okay leaving your money in a vehicle that year after year after year is going to pay less and less and less return to you? Or is it a good opportunity to refinance some of that money into a vehicle that you know is going to guarantee you 4.5, 5.5%, not for 1 year, but for 2 years or 3 years or 4 years or 5 years? What that means is when interest rates very well could be back down around the 2.5, 3% range, which that's where the feds want to go, by the way. If interest rates get down around that 2.5, 3.5% range, would you rather have your money paying you still 5%, 5.5% or more? And the only vehicles that we're seeing right now, Tony, available to do that in are those MIGAs, multi-year guaranteed annuities. And I think it's a great opportunity. Again, refinance is a no-brainer to make more money, especially if we can make more money and lock in those rates for a longer time, get ahead of the lower interest rate curve.
Yeah.
Again, it's a no-brainer. It can only be a positive thing.
That's huge. Yeah, you want to get ahead of the curve. And really the way to accomplish that and to really make the most, get the most impact that's beneficial for you from lower interest rates is to be working with a trusted financial services professional who's also a fiduciary like you and your team there, who's going to be looking out for your best interests and knows how to take advantage of lower interest rates, and who can make adjustments to your portfolios, your situation, and look across the board at everything you've got going on, whether you're, 10, 15 years out from retirement, whether you're retiring this year, whether you've already retired. Get a second opinion on where you're at. Lower interest rates are a reason to maybe take a look again at where you're at and what you need to be doing. And a good way to do that is to contact Jason and his team at Great Lakes Investment Advisors. Jason, I love the fact that you offer a consultation to our listeners out there. You set aside some slots each week where you can, you and your team can meet with them, and it's a no charge, no obligation consultation. And listeners, all you have to do is pick up the phone and call to set up that appointment. That's 989-835-7203. You'll also get a copy of Jason's book, Empower Your Retirement. And you can also set up that appointment by going to the website, greatlakesinvestmentadvisors.com. All right, you're listening to your Financial Empower Hour. I'm your co-host, Tony Shore. I'm here with Jason Cryderman. Jason, our host and the man with the plan. And today it's all about interest rates. That Fed, crazy. It's weird because, the economy is at a point where it might have needed a little bump, but yet, the job numbers are starting to look a little shaky. And so the Fed comes in and lowers interest rates, but really we'd been pretty strong. And in somewhat of a surprise for a lot of people, the market has been setting record highs even before that. But I've heard speculation that the reason the markets have been doing so well, one of the reasons, is because of the anticipation that the Fed was for sure going to lower rates, right? That promise of lower rates. And why would the stock market be positive on lower interest rates? It's because companies can do better then, right? They can.
Yeah, well, I mean, I think it's again, that's a double positive. It's positive. If we look at the stock market is driven by us as consumers who spend money, who help these companies increase their values, and then we buy stuff in the stock market, right? And then the other side is the corporations. As we spend money, whether it be at restaurants or clothes or gas, whatever it is, that's one side of the equation for the stock market. The other side is when we spend money, these corporations make money, right? So if they can be more profitable, the more we spend, the more profitable they are. Interest rates impact both sides of that equation from a very positive aspect when we talk about borrowing money. So if I can borrow money cheaper, I might take out more credit card debt. I might buy another car. I might buy a boat. I might buy another house. I might do things from a consumer standpoint. I might spend more money if it doesn't cost me as much. That's a very positive thing for these corporations, because as we spend more money, the corporations make more money. And from the corporation side, if they can borrow money cheaper, they might do more research and development. They might spend money on that. They might do more mergers and acquisitions and buy up other businesses. They might spend money on labor. So they might say, hey, we're going to take some money, re-leverage it. It's cheaper than it was yesterday. It'll be cheaper. So we might borrow money and actually grow our business. Now that could also increase jobs as they do mergers and acquisitions, as they do research. Anytime that a business can borrow money cheaper, it's going to have a positive impact on their bottom line. And anytime a consumer can borrow money cheaper, generally it doesn't necessarily have a positive impact on our bottom line, but we spend more money. Generally, the lower interest rates for consumer encourages us to spend more money. Lower interest rates for corporations enhances them to make more money.
Yeah, because they can borrow more and expand. It's better for companies and expansion, hiring. It's all good. It pulls up the economy. If a company knows it can borrow at a lower rate, it can use that money to hire more people, offer more products, innovate different things, and expand and grow, which is good for consumers, good for the economy, and it helps consumers want to spend more then, and that also helps the economy. We have a consumer-driven economy, and the stock market is based on these companies. So if they do better, we do better in the markets, which is a good thing. So it's cyclical somewhat, and lower interest rates help that, which I think that's why it's been pushed for. But our economy, to be honest, going into it before the rates were raised was pretty good. We saw
a few, we
saw a few indicators with the jobs reports, maybe, but overall, the U.S. economy is strong and it's resilient, which is good. I mean, we've had huge things to happen to our economy, right? I mean, COVID 2022, when the stocks and bonds went down at the same time, everybody thought we were going to slip into a pretty bad recession. We didn't.
No, we pulled back out of that pretty quick and pretty strong.
Yeah, and hit record highs pretty quick after that downturn. So it ended up being a little more of a correction than an actual recession, which is good. So all that to say, great show so far, and there's a lot to this topic. I know there is, and we talked about investors, bonds might be less attractive though when interest rates are down, right?
Yeah, so that's one side of those fixed investments or safer money. We call it here in the office safer money. And what falls under safer money? Well, investments that don't have as much risk. Maybe they have zero direct stock market risk, like CDs, fixed annuities, MYGAs, and they have limited interest rate risk. Obviously, the longer you can lock in a better rate, like in a 3-year or 5-year MYGA, the longer you have to worry about interest rate risk at all. So that's a double positive, a double benefit. Now, bonds are a unique creature because as interest rates go down, the bond yields are going to change as well. So you got to pay attention to, what's your yield? What is the term of your bond? What is the credit quality of your bond? All those variables when you talk about bond funds, because yes, increasing interest rates and lowering interest rates will also have an impact on bonds. And so what worked last year in a higher interest rate environment might not be paying as much yield, which another word for yield is income, right? Dividend yield or income. It might not pay as much income in a bond fund. So if you need to get income or higher yield out of that account, you may want to look for alternative investments as well, because with lower interest rates, there's just not as much spread available in a lot of those bonds that they can afford to pay a higher yield, a higher income.
Yeah, exactly. Well, and I think this is a great discussion, and it comes back to our listeners who are retired already or nearing retirement, very close, entering retirement this year or next. Lower interest rates can be a little tough because they need those things we were talking about, like MYGAs, CDs, some of the safer ways to have your money invested for retirement. As you get older, you want less at risk. So I know you've helped clients move money into things that have principal protection, like fixed index annuities or a MYGA or a CD, things like that. And if they have some of their money in those things, when interest rates go down, they're going to earn less, and you want to be able to keep up with inflation. But you have strategies for that, don't you?
Yeah, absolutely. I mean, when we build and manage plans for families or investors, we got to look at what's going on today, right? Are we in a high interest rate environment? Are we in a low interest rate environment? Are we in an increasing or declining future outlook of that environment? So we don't just look for today. We need to build a plan, and it's a tagline of my book. It says, plan for the best, but prepare for the worst, right? We want to plan for high interest rates when when we're investing money, but low interest rates when we're borrowing money. We want to plan for only a rising stock market. We want all those great things, right? But when we build these plans, we have to look at today, what's our current environment look like, and what is the future outlook over the next 5, 10, 15 years of your retirement, or as you're getting closer to retirement, or as you're building up the younger generation building up to retirement. You want to really focus on what's the environment and build that plan with flexibility. We always sit down with our families on a quarterly basis, semi-annual, annual basis, and we review the current plan.
Yeah.
What is the current plan doing today? How are the aspects of the environment around us, whether it be interest rates, be bond yields, be stock market, international markets, whatever it might be? How are those looking today under today's environment as compared to what they looked like 6 months ago or a year ago? And what's the outlook of all these variables looking like over the next 6 months to a year or so? So you have to have a plan, be prepared, and don't be afraid to adjust your plan. I think it's so important and it has such a powerful impact. The more often you review your plan and the more often you're able to adjust that plan, especially more proactively, the more prepared you're going to be and the better your financial life will be as well.
There you go. And to get that plan, listeners, we're out of time, but to get that plan in place, give Jason and his team a call. 989-835-7203. That's 989-835-7203. Or go to GreatLakesInvestmentAdvisors.com. Jason, great show. Listeners and viewers, thanks once again for tuning in. That does it for today's episode of your Financial Empower Hour with our host, Jason Cryderman.